If you don't know this before buying a stock, you are gambling. Today, I'll show you the exact process that I use to decide if a stock is worth buying. And this is the same method that I used right from the very first year I started investing, from all the books that I've read, such as One Up on Wall Street, Common Stocks and Uncommon Profits. And this is what I do before I buy any stock. It's not a perfect method, but it is simple and it keeps me from losing money. So as usual, I'll give you the immediate answer, which is the intrinsic value and the stock price of any stock is just the book value per share plus the net income per share that you estimate annually that you will get. And it's just as simple as that. And if you just understand these two things, you just understand this one equation, you are ahead of 90% of the investors and you will be able to beat the market, which is the S&P 500. Make more than that 10% a year. But first, you need to know accounting. I don't need you to know all the accounting laws and all the tax laws and how to do like a corporate accounting or whatever, but you need to know enough to read the three financial statements, which is mainly the balance sheet, income statement, and cash flow statement. So now, how do we calculate a stock price? First, let's look at the first part of the equation, which is book value per share. And to understand what is book value per share and understand what is a stock all about, we need to understand this fundamental accounting equation that we will all encounter in whatever accounting module. This is the first equation, lesson one, they will teach you. Asset equals to liabilities plus owner's equity. So now, why do we need to know about this equation? This is because a stock is classified under the owner's equity in the balance sheet of any company's financial statements. And let's say we have this company called the KKB company, all right, the Kukuba company. Let's say they have 200 million in asset, 150 million in liabilities, 50 million in owner equity, and they have like 50 million shares outstanding. You will get $1 per share when they go bankrupt. Now, how do I know this? $1 per share, and this $1 per share is book value per share. And how do I know this? This is because when they go bankrupt, they will have to sell their asset for cash and then use their cash to pay off the liabilities. And then afterwards, since you are a shareholder, you are the owner of the company, the cash will be split equally among all the shareholders by the number of shares that you own. So now back to this Kuku company example. Let's say they go bankrupt, they will sell 200 million in the cash, their asset into the cash, and then they will pay off like 150 million liabilities, and then like that's 50 million left, which is also known as the book value, divide by the number of shares outstanding, 50 million, let's say for example, you get $1 per share. And there's a very simple way of understanding. You don't need any complex financial models, just this is good enough. And you can understand that, hey, when I look at this company that's about to go bankrupt, the stock price on the market should be $1 per share. It should not be anything more than that. If anything, I'm going to get back lesser than what I invest. And let's look at some real life examples. Let's say Walmart, what's their book value per share? What is the amount that I should get if they go bankrupt today? So we can see that Walmart currently has 288 like billions in asset, 186 billion in liabilities, and 102 billion in equity. And the number of shares outstanding that they have right now is like 8 billion. So if we take that, just take the 102 billion divided by 8 billion, you get $12.75 per share, roughly. All right. So which means if I buy one share of Walmart at $117 and they go bankrupt today, I can only get back $12.75 per share, which means this is a losing investment, right? I'm gonna be losing like about $105 or something if I buy a share of Walmart today. And using this idea, if Walmart's current stock price is above $12.75, which it is, I don't buy the stock at all. All right, I move on to value at the next stock. And it is below $12.75, I buy. All right, I'll buy it because it's an undervalued stock and because like uh, it is an undervalued stock. Eventually, it will reach $12.75 and I'll profit. And the reason why it will reach eventually is that Let's say you are a huge investor, you own billions and billions of dollars. You can just buy over the company, and if you just sell the company immediately, just liquidate all the asset and sell it immediately, you get that $12.75 immediately. So all you need to do is just to buy the company, and let's say it's like $10, and you just like stop the operations, sell everything, sell all the assets, pay off your debt, you will get $12.75, and that is a $2.75 profit. Now you may ask me, why is Walmart selling at $117 so expensive? And it's like so overpriced, so much more than the $12.75 that I will get if they go bankrupt today. And this is such a losing investment, right? Because if I invest in it, they decided to stop operating, I'm going to lose $105 by buying one share, right? So the answer is just because they are currently still operating. All right. They are not a business that's going to go bankrupt. It's a very famous brand. It's the NTUC of America. It's going to continue to operate. That's why it is selling at $117 because they are currently making profits, and there are more profits in the future years to come. And when we look at their current stock price, we can see that investors are expecting Walmart to operate for another 43.4 years, assuming that they maintain their current profitability. And how do I know this? It's because let's look at the second part of my equation, which is net income per share. This is also known as the earnings per share. All right. So this second part of the equation, net income per share, is for a company that is still operating and still alive. And you add it to the book value per share to know what stock price that the company should be selling right now. So now let's look at the second part of the equation, which is net income per share. So we can see that their net income for the most recent year, it was 19 billion, and then their number of outstanding shares is 8 billion. And that's how you get like $2.42 in terms of the net profit per share, that like net income per share that they can get annually. So when we look at the discrepancy between the stock price and their book value per share, yes, you will lose $105.08 for every share that you buy if they decided to like go bankrupt or stop operating tomorrow. But because they are a surviving business, and because investors assume, like let's say we assume that they can maintain their current profitability of $2.42 per year, they are going to continue to earn $2.42, right? So investors are expecting that they are going to survive for another 43.4 years. And how do I know that? Just take the discrepancy, which is $105, divided by the $2.42. And that's how you get like the 43.4 years at the current share price. Okay, next, let's look at when will this valuation method fail, which is the downside of this method, right? Because not all method is perfect. This method is simple. It doesn't use any complex financial models. And the answer is that when you misjudge the number of future operating years. So let's say I got it wrong, like Walmart, hey, instead of I buy the share now, and like instead of operating for another like 44 years, if they manage to operate for another 44 years, I'll make some money on my investment. But let's say they go bankrupt in 5 years later, I will definitely lose money, right? So when you misjudge the number of future operating years, when you misjudge the net income per share and the number of years that they will continue to operate, that's when you will lose money on this investment. And here comes the question. So how can Walmart survive for another 43.4 years? Now, this is a very subjective question, and this is why valuation is very subjective. We need to think about what is Walmart's source of revenue, and can they maintain their net income? Will customers get tired of their product? Can they increase revenue by expanding to other countries? Will their suppliers screw them? Will their employees screw them? Will their competitors destroy their source of revenue in the next like 43.4 years? So now this is a very tough question to think, and these are all the questions that you should research and think about it. And if you know for sure, oh, okay, Walmart can survive for another 100 years, all right, then this is an investment for you. But if you think like, hey, I really don't know, maybe Walmart can only survive for another like 5 years. I really don't know, maybe Costco will just destroy them 5 years later, right? Then that's when you don't invest, all right? You stay away from this stock. That's because the market is expecting them to survive for another like 43 years, but there's no way, right? Maybe it's not realistic that they can do that, right? And my final takeaway for you is that I mean, to estimate a company's like whether they are able to survive for another 43, 44 years is a really, really tough question. Even like uh let you time travel back 50 years ago, you wouldn't even know like whether the best railroad company that at the time the best company is railroad companies, and like you look at them now, they are already gone, right? So if you don't know like the stock and you don't know how long the company can survive, just move on to the next stock. Move on to the next stock that you will understand. There are so many, many, many stocks in the like let's say US market, just the US market alone. You can just look at each and every one of them and then like use the valuation method. You will come across one company whereby the market is valuing a stock as if they are going bankrupt. They are going to go bankrupt soon. But you know for sure this company can survive for another 2, 3 years. And this additional 2, 3 years of profit is how you make money on your investment. And I just want to say that my current method just handles the quantitative part of an investment. You know, an investment has qualitative and quantitative part. I mean, just by the quantitative part is really enough for you to beat the market, beat the S&P 500 and get more than 10% per year returns. And for the qualitative part, I'm kind of just too lazy to do it, man. Like it's too much effort. The qualitative part is actually so much more difficult when you think about a company's competitive advantage. So, well, if you like more videos like this, if you want me to talk about the qualitative part, I'll just check the reaction of this video. It's probably not gonna be much. I mean, if there's you would like more breakdowns like these and lessons, I try to post one every week. And remember to like, share, and subscribe so that you can keep updated on my next video.